Wall Street is pumping AI stocks so hard right now, it's almost funny. And at the same time, those same stocks are falling apart in front of you. That's not a typo. That's not me messing up. Every analyst on television is telling you to buy, buy, buy. And while they're saying that on camera, the actual stocks are getting crushed. I've built companies, I've sold companies. I've sat across the table from bankers my whole life. And I'm telling you right now, when the people selling you the dream are getting rich, no matter what happens to you, that's when you need to pay the closest attention. Because somebody is about to get left holding the bag. And if you're not careful, it's going to be you. So stick with me for the next few minutes, because I'm going to break down exactly why the biggest names on Wall Street are screaming buy while their own trading desks are quietly running for the exits. This is the kind of stuff nobody explains to regular people. And by the end of this video, you're going to understand this AI stock mess better than most people who work in finance for a living. Now look, what I'm about to walk you through could save you real money or make you real money, depending on what you do with it. This isn't fluff. This isn't some generic advice you already heard 100 times. This is stuff that took me years of being in boardrooms and cutting deals to actually understand. So if that's worth something to you, do me a favor and hit subscribe right now before we go any further. It costs you nothing and I'm giving it to you for free. Let's start with the guys doing the cheerleading, because you need to understand exactly how this machine works before anything else makes sense. I've sat on the other side of this table more times than I can count. When I was running companies and looking to raise money or get acquired, banks would come in and pitch me on why they should handle the deal. And I promise you, not one of those meetings was about what was best for some random investor sitting at home. It was about fees, big fees, underwriting fees, advisory fees, trading fees, fees for basically breathing near a transaction. Investment banks make more money keeping a company happy than they ever make from some research report being accurate 5 years down the road. So when you see a wall of buy ratings on a stock, understand what you're really looking at. You're looking at a bunch of companies competing for future business, dressed up to look like independent analysis. That's not a conspiracy theory. That's literally how the business model works. And anyone who's worked inside it will tell you the same thing. If you get them off camera, every big investment bank has an army of analysts whose entire job is to slap a rating on a stock: buy, hold, sell. And here's the part almost nobody tells you. Those analysts don't work for you. They work for the bank, and the bank makes its real money doing deals with the very companies they're rating. When a bank puts a buy rating on a hot AI stock, they're not doing charity work. They want that company's business. They want to underwrite the next bond offering. They want to run the next stock sale. They want to see the table when that company needs to raise a few $1 billion. So when you see 18 out of 19 analysts screaming buy on some AI darling, what you're actually looking at is 18 firms competing to stay friendly with a company that pays them enormous fees. I've been in the room when banks pitch for business, and let me tell you, glowing research notes are part of the pitch. It's a relationship business dressed up as objective analysis, and regular investors mistake it for the truth every single time. Think about the incentive structure for a second, because incentives explain almost everything in business and in life. If you're an analyst and you slap a sell rating on a company that's about to raise $10 billion in debt, guess who's not getting invited to bid on that deal? Your own firm. Your bosses aren't going to be thrilled that you just cost the bank a 9-figure fee because you wanted to be honest. So the incentive isn't to be right. The incentive is to stay close to the deal flow. And staying close to the deal flow means staying friendly, which means staying bullish, which means putting out buy ratings even when the numbers underneath the company are shakier than the headlines suggest. This isn't me guessing. I've watched this exact pattern play out again and again across different industries, different decades, different hot trends. The names change, the game stays exactly the same. Here's what really opened my eyes, and it should open yours too. While the public-facing research says everything is wonderful, the trading desks inside those exact same banks are positioned completely differently. Traders get paid based on whether they make money, not on whether they keep a client happy. So they don't care about relationships, they care about being right. And when you start hearing whispers out of trading, fours using words like carnage to describe what's happening, in AI-related debt and credit markets. That tells you the smart money already knows something the buy rating crowd isn't saying out loud. Wall Street isn't one voice. It's two completely different departments giving you two completely different messages, and only one of those departments is betting real money on what they believe. Now let's talk about what's actually been happening to these stocks, because the numbers are almost hard to believe. You had a 100-plus-year-old technology company post the worst single trading day in its entire history, worse than the crash of 1987, worse than the dot-com bust, worse than the 2008 financial crisis, worse than COVID. Think about that for a second. This is a company that survived world wars, survived the Great Depression's aftermath, survived every recession in modern history, and it just had its single worst day ever in the middle of what's supposedly the greatest technology boom of our lifetime. If AI is really the unstoppable freight train everybody claims it is, how does one of the biggest names in the industry have a day like that? That's not a coincidence. That's a warning shot. I want you to sit with that for a second, because most people hear a stat like that and their eyes just glaze over. This is a company that's been through literally every major economic disaster of the last century and came out the other side: wars, oil shocks, inflation crises, multiple recessions, the birth and death of entire technologies, and in the middle of the supposedly greatest technology shift of our generation, it has its single worst day ever. That's not just bad luck. That tells you something structural is shifting underneath this entire AI trade, and it's shifting fast. When a company that old, that stable, that boring in a good way, gets rocked harder than it did during an actual global financial collapse, you don't shrug that off. You pay attention. And it's not just old school tech names getting hit. Some of the most hyped, most talked about companies in this entire AI wave have bonds trading like junk debt. When professional bond traders start pricing a company's debt like they think there's real risk of default, that's the market telling you something the stock cheerleaders refuse to admit. Bonds are boring. I get it. Nobody wants to talk about bonds on social media. But bond investors are typically far more disciplined and far less emotional than stock traders chasing the next big story. When bond markets get nervous about a company everyone online is obsessed with, you should get nervous too. That disconnect between the public hype machine and what professional debt investors are actually pricing in is one of the clearest signals I've seen in years. Let's get into how this AI boom is actually being funded, because this is where it gets uncomfortable. A huge chunk of this so-called AI revolution isn't being paid for with real profits sitting in the bank. It's being paid for with debt. Companies are borrowing enormous amounts of money to build data centers, buy chips, and expand capacity, betting that future AI revenue will eventually cover the bill. That's not automatically a bad strategy. Businesses borrow money all the time. I've borrowed money to build businesses myself, but there's a difference between borrowing against a proven cash flowing business and borrowing against a promise that hasn't fully arrived yet. A lot of what's happening right now looks a lot more like the second one. And when you layer massive debt on top of assets whose future value depends entirely on continued type, you've built something fragile. It works great in a rising market. It gets ugly fast the moment sentiment turns. Because now these companies don't just need AI to succeed, they need it to succeed on a very tight schedule to make their debt payments. And here's the thing about debt that people forget. When everyone's feeling good, debt doesn't care about your story. Debt doesn't care that you're building the future. Debt doesn't care that your product is incredible. Debt just cares about one thing: whether the payment shows up on the date it's due when times are good. Carrying a lot of debt makes you look aggressive and smart. The moment revenue slows down even a little, or interest rates stay higher for longer than expected, that same debt turns into a noose. I've run businesses with debt on the books, and I can tell you the discipline required to manage it properly is completely different from the discipline required to raise money when everybody wants to hand it to you. So right now, a lot of these AI companies are in the fun part of the cycle where lenders are practically begging to hand over cash. Nobody's talking enough about what happens when that mood flips. And in markets, that mood always eventually flips. On top of the debt, there's something even trickier going on, And I want you to really pay attention to this part because it's the kind of thing that sounds complicated but is actually pretty simple once you see it. Several of the biggest names in AI are doing deals with each other where money moves in a circle. One company invests in another company, that company turns around and spends that same money buying products or services from the company that just invested in it. Then that gets counted as revenue. On paper, everybody's growth numbers look fantastic. Revenue is up, investment is up, everybody's happy, but strip away the fancy structure and ask yourself a basic question. Is any new money actually entering the system from outside customers who genuinely need the product? Or is it the same handful of dollars getting passed around in a circle, getting counted as revenue every time it changes hands? I've seen versions of this trick before in other industries, and it always ends the same way. It works beautifully until the music stops. And then everybody realized the growth was partly an illusion built on related party transactions instead of real outside demand. Let me put it in simple terms so it really clicks. Imagine you and I start two companies. I invest $100 million into your company. You then turn around and spend that exact $100 million buying equipment from my company. Now both of us can go tell investors, our revenue jumped by $100 million. Sounds amazing, right? Except no new money entered the system. It's the same $100 million bouncing between two pockets, and we both got to count it twice, scale that up to billions of dollars, spread it across several major AI companies, all investing in and buying from each other. And you start to see how impressive looking revenue numbers can be built on a foundation that's a lot thinner than it appears. I'm not saying every deal in this space is fake. Plenty of AI demand is completely real and completely legitimate. But when you can't tell how much of the growth is genuine, outside demand versus money going in a circle, you should treat those growth numbers with a healthy amount of suspicion instead of blind faith. There's also this fast-track index inclusion trick that a lot of people don't fully understand, and it matters more than you'd think. Normally, getting into a major stock index requires a real track record, real trading history, real minimum size requirements. Recently, some of these rules got fast-tracked or loosened for certain hot companies, letting them into major indexes on a much shorter timeline than usual. Why does that matter to you? Because once a stock is in a major index, every single index fund and every retirement account that tracks that index is forced to buy shares, whether the fund manager believes in the company or not. That's not real conviction. That's mechanical automatic buying because of a rule. It creates a wave of demand that has absolutely nothing to do with whether the underlying business is actually good. And here's the part that should bother you the most. That automatic buying pulls in ordinary people's 401 kilobits money and retirement savings, money that didn't choose to bet on this stock. It just got dragged in because of an index rule. That's not investing, that's forced participation. And most people don't even know it's happening to their own retirement account. Think about how backwards that is for a second. You worked hard for your money. You put it into a retirement account thinking it was being managed responsibly, spread across hundreds of solid, established businesses. And because of a rule change nobody voted on and almost nobody understands, a chunk of that money automatically got funneled into a company that's barely had time to prove anything as a public business. You didn't pick that stock. Your fund manager didn't even really pick that stock in the traditional sense. A rule book picked it for you. That's the kind of thing that should make people furious once they understand it. Because it means stock prices can get pushed up by mechanical requirements that have nothing to do with whether a business actually deserves that kind of money behind it. So who's actually selling while all of this is happening? This is the question I always ask myself in any deal. Who's on the other side of this trade and why? And when you look at insider selling patterns at several of these hyped AI companies, you start to see executives and early investors cashing out significant amounts of stock while the public narrative stays extremely bullish. Now, insiders sell stock for all kinds of normal reasons. I'm not saying every single sale is a red flag, but when you see a pattern of heavy insider selling happening at the exact same time that public-facing analysts are pounding the table, telling everyday investors to buy more, you have to ask yourself who has better information about that company's future. The person running the company or the analyst who's never worked there a day in his life. I built and sold a company myself, and I can tell you insiders sell when they believe the price reflects as much good news as it's realistically going to get for a while. That's not a guess. That's experience talking. When I sold broadcast.com, I understood better than anyone on the planet exactly what that company was worth and exactly what it wasn't worth. Insiders always have the best seat in the house. They see the actual contracts, the actual churn, the actual costs, the actual risk, long before any of that shows up in a headline or an earnings call. So when insiders are quietly selling large blocks of stock while the public story stays rosy, that gap between what's being said and what's being done is one of the most honest signals you'll ever get in the market. And it costs you nothing to go look it up. Let me bring this back to something practical, because I don't want you walking away from this just scared and confused. I want you walking away smarter. The lesson here isn't that AI is fake or that the technology doesn't matter, because it absolutely does matter, and it's going to reshape entire industries over the next decade. I fully believe that. The lesson is that there's a massive difference between a good technology and a good stock price. Those are two completely different things. And Wall Street loves to blur that line because confusion sells more shares than clarity does. A company can be building genuinely revolutionary technology and still be a terrible investment at a certain price, especially if that price was built on borrowed money, circular deals, and forced index buying rather than real, sustainable, outside customer demand. So what should you actually do with all of this? First, stop outsourcing your thinking to analyst ratings. Understand who pays those analysts and what they get out of giving a positive rating. Second, pay attention to the bond market and to credit conditions, not just stock prices, because debt investors tend to sniff out trouble before stock traders do. Third, look for real revenue from real outside customers, not revenue that's bouncing between a small circle of companies that all have investments in each other. Fourth, watch what insiders are doing with their own money, not what they're saying in interviews. And fifth, remember that index inclusion creates buying pressure that has nothing to do with a company's actual quality. So don't mistake a rising stock price for validation of the business itself. If you keep these 5 things in your head every time you hear someone screaming, buy on television, you're going to make better decisions than 90% of the people watching that same segment. I want to leave you with a challenge, and I mean this sincerely. The next time you hear a wall of analysts telling you to buy something, I want you to go look up who those analysts work for, and I want you to check whether that bank has any other business relationship with that company. It takes 10 minutes. Do that homework before you put your hard-earned money anywhere. I've made a lot of money in my life, and I've also made plenty of mistakes. But every single mistake I made came from trusting somebody else's confidence instead of doing my own homework first. Nobody cares about your money as much as you do. Not the analyst on TV, not the bank trying to win the next underwriting deal. Nobody. This AI boom is real in a lot of ways. The technology is genuinely powerful, and it's going to change how businesses operate for decades to come. I have zero doubt about that part. But the way a chunk of it is being financed and hyped right now has some serious cracks in it. And those cracks are showing up in the data, whether Wall Street wants to admit it on television or not. Old, stable companies don't have the worst day in their history for no reason. Bonds don't trade like junk for no reason. Insiders don't sell in size for no reason. Every single one of these signals is a piece of the same puzzle. And once you see the full picture, it's a lot harder to just blindly trust the next round of buy ratings that show up on your screen. So don't get caught up in the noise, and don't let anyone's confidence substitute for your own homework. Do the work, ask the hard questions, follow the money instead of following the headlines. And remember that the loudest voice in the room is usually the one with the biggest fee riding on your decision. If this video actually helped you understand what's really going on, hit subscribe. Share it with somebody who needs to hear it, and drop a comment telling me which part surprised you the most. I read every single one. I'll see you in the next video.